welcome back to this week's market update. Today is Monday, October 7th, 2024. And with that, we will hop right in. Stocks started the week on a negative note, impacted by news of heightened tensions in the Middle East and union strikes along East Coast ports. So you can see a little bit of a sell-off to start the week, and then stocks later regained a lot of that territory as the September jobs report came in strong and the union strike was resolved. As of Friday, October 4th, the only positive index was the Dow that was up just 0.05% on the week, while the S&P 500 and Nasdaq Composite were down about 0.3% on the week, and then last but not least, the Barclays Aggregate Bond Index down about 1.3% last week. Heading into our economic news from last week, the September jobs report came out much stronger than expected. We saw the unemployment rate tick down to just 4.1%, below expectations of 4.2%. Alternatively, we saw the non-farm payroll gains jump to 254,000 in September, significantly above the estimates of 145,000. We saw sectors experiencing the largest monthly job gains include leisure and hospitality, healthcare, social assistance, government, construction, as well as professional and business services. So pretty widespread job gains in the month of September. We did see declines in manufacturing and transportation and warehousing, though. And then last but not least, we saw the average hourly earnings rise by 0.4% in the month of September, up 4% compared to a year ago. So wage gains are starting to outpace inflation. Overall, we saw this really stronger than expected jobs report drive some market gains on Friday and perhaps delay some of the further rate cuts as the Fed decides on their monetary policy in the coming months. Just ahead of September's jobs report on Friday, we also got the job openings and labor turnover survey for the month of August. It showed that the number of available positions rose to over 8 million here in the month, which was higher than July and well above the estimate of 7.7 million that economists had expected. We also saw the quit rate decline to 1.9%, which was the lowest level since 2020. Overall, you can see even in this chart, we are much closer to levels seen in 2018, 2019, right before the pandemic, coming down from this post-pandemic spike as employers tried to recover employees as demand surged and the economy quickly recovered from this COVID-related pandemic. So overall, just a very normalizing labor market for what we see right now in the data. Manufacturing continues to be a weak link in the U.S. economy, as we saw in the September jobs report, manufacturing losing quite a few thousand jobs in the month of September. We also saw that in the ISM manufacturing PMI here in September. So that remained unchanged at 47.2 in the month. Anything below 50 is considered bearish, while anything above 50 is considered bullish. So we have been below 50 for quite some time, with the one exception of March here, ticking above 50 slightly for just 1 month. Overall, has been a very bearish scene in the manufacturing industry. We've seen manufacturers report that demand has stayed soft, output has been falling as a result, but inputs do remain accommodative. So this reflects quite a few of these dynamic challenges in the manufacturing sector. We also saw many companies cite a reluctance to invest in capital and inventory due to restrictive monetary policy, higher borrowing costs, and election uncertainty in the coming months. So a lot will evolve in the coming months and quarters as the Fed continues to loosen monetary policy and the election results become known. So very interesting stuff here, and we will take a look at the service sector in the next slide. On the other hand, we have the ISM Services Index, which has shown a lot of continued strength and stability in the U.S. economy. It came in at its highest reading since February of 2023 at 54.9, also quite a bit above the 12-month average of 51.8. Very, very bullish reading in the month of September, and that aligns with the strong September jobs report as well. So in one half of the economy, we have manufacturing, where goods prices in many categories are actually falling because demand is weaker and sales volumes are weaker. And on the other side of the economy, we have the service side, which has been extremely strong. It has been the primary driver of growth in the last year or two, and it continues to be a source of jobs as well. Last but not least, we had a potentially larger issue become resolved as the union port strikes that began on Monday, September 30th at midnight got resolved by early Friday morning. So you can see these ports that were affected range from Boston all the way down to Houston, from the northeast to the southeast of the United States. If they had been more prolonged, it would have caused supply chain disruptions even further, as well as it could have put a lot of upward pressure on inflation, especially as the Fed has started to cut rates. So, could have been a potentially larger issue, but for now, they seem to have come to an agreement, at least through January. So, we'll continue to monitor the situation, but this smaller crisis has been very much contained and resolved last week. That is it for this week's market update. We thank you so much for tuning in, and we look forward to seeing you next week. The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.